Bismillahirrahmanirrahim. Assalamu alaikum everyone. Hussain Qazi here. A very warm welcome to my another IFRS 18 session. This time we will cover a topic, management defined performance measurement, MPMs. We will call this topic MPMs. So first of all, we need to decide what's the sequence of the lecture that I will cover here. Number one, as usual, I will start this lecture with a discussion to develop a mindset. Number two, I will enter with IFRS 13, particular MPMs, particularly the topic MPMs with a business case, ABC retail company. Then I will refer my notes and then I will jump to point number 6, practice question. We will discuss the practice question. ACCS published through the specimen, the question name Kiki. Then another topic we will cover, a small topic, that EBITDA and OBDI. What is EBITDA, what is OBDI, and what's the difference? Then I will make a reference of my notes, and the lesson will conclude by handing over a self-attempt practice question to Basco. Okay, so let's start. To remember, IFRS 18 and particular topic, management defined performance measurement. So first we are going to enter with a discussion, basic discussion, to develop a mindset. What is this topic about? Let's start. Wow, a P&L. A P&L. This is a P&L. The structure of this P&L with viewpoint of IFRS 18. Categories, operating categories, investing categories, finance categories, and tax category. Ignore discontinued operation. Subtotals, mandatory subtotals, operating profit, profit before finance and income tax, and the final profit. Optional, profit before interest and tax, and other more optional possible. Okay. So assume that you are sitting at the boardroom, no? In fact, a board meeting is going on, and the scenario is that all the profit and loss account, it's now become final. It's now become finalized, and just 2 to 3 days more to publish this P&L, to publish, in fact, the complete final accounts. The complete final accounts, that like the Toyota's final accounts, all things completed. But one last discussion here at the boardroom. But before that discussion, you have to notice the important point. What is the point about? Here, the company going to present according to IFRS 18, the operating profit, for example, $1,000. And here the company wants to disclose these two items as a separate line item. Restructuring cost, forex gain and debtors, a separate line item. Because of that, they have already applied the principle regarding aggregation, disaggregation. Then they have decided to disaggregate as a separate line item. They have already applied the materiality. Assume all they have done in a right manner with full relevance, conceptual framework matter of the relevance, materiality, faithful representation. This is absolutely right. So this is what they are going to discuss. Oh, sorry, this is what they are going to present. But sir, if everything is finalized, what's the agenda of today's board meeting? Yes, the agenda of that particular meeting is that, and do remember that, as you here at the boardroom, you are one of the board member. For example, you are finance director and responsible for this annual accounts, all presentations. All presentation means P&L, the notes of the P&L, balance sheet, and all these things. And in front of you, another board members already have, and like CEO and other members as well. and you are listening the communication of CEO and other board members. CEO initiated the discussion and said that at that particular board meeting, so Mr. Finance Director, I have a wish to disclose this operating profit. Disclose this operating profit. I use the term disclose. Disclose means disclosure. I wanted to make a disclosure, not in the front of the P&L. I wanted to make a disclosure, this operating profit, in a way that's more useful to the user of the financial statement. So as a finance director, you replied, sir, what do you wanted to disclose? So finance director, CEO replied that I wish to disclose, to make a disclosure for this. What is this disclosure? You have to listen my lecture very carefully. CEO says that, Mr. Finance Director, this is the operating profit that we are going to publish. But I wanted to communicate, I wanted to disclose to the user of the financial statement that these two items, restructuring and finance forex gain, these are one-off items. These are not the regular items. So I wanted to develop another profit by name underlying profit, by name adjusted operating profit, by reversing these two accounts. Do remember, this is just a disclosure. It's not about something to make reversal entries. It's just about to disclose. As a finance director, I asked to the CEO why you wanted to make this disclosure. CEO replied that I wanted to make this disclosure to make more precise communication to the user that $1,000, it's not the future expected cash flows that need to project. These are not regular cash flows, because this 1,000 includes restructuring and the forex gain. This is one-off item. If user wanted to know what's the operating profit that we can project as a regular or sustainable matter, in fact incorporate the growth as well. So this 1100, it's a valuable information for them. Number one. You as a finance director said, that's relevant. Anything else, Mr. CEO? CEO replied, yes. I also wanted to show my company or my team performance. My team performance in a more better way, in a more transparent manner. That's these two items are not regular, it's one-off. We will also provide some description here for clarification about these two accounts, from where the user can easily gauge our performance. Do remember, this is what the wish the CEO have, or CEO or other team members. Finance director replied, as a professional accountant, we're responsible for applying the IFRS. We will reply to the team members or the CEO. Sir, I wanted to check what IFRS 18 says for this. Was IFRS 18 having a structure about this disclosure? Then I will let you know. More specifically, whatever in the P&L is a separate line item. Number one. And if we wanted to disclose something extract from the P&L, and add on with the notes. And add on with the notes. This is what about the topic we are going to discuss, and welcome to the session called MPMs. Ladies and gentlemen, I hope that it's very much clear to you what the topic we are going to discuss. Management performance measurement. IFRS 18 use the term management defined performance measurement, MPMs. If any of the company wanted to disclose the performance measurement, do remember performance measurement, something from income statement, wanted to something need to extract and develop some adjusted profit and wanted to make that as a disclosure, we will let you know what's the guidance. We will let you know what's the structure. Follow our structure. Your wish is not important. Whatever we will describe, whatever we will say, you have to follow that and disclose by name management performance structure. So it's very much clear. Now, why not to discuss this point with a case? Let's simplify this issue with a case study and then refer to the notes. It's not very much extensive topic. Don't worry about that. Assume if we extend that particular example with a case study like this, read it. ABC Retail Limited operates 150 stores across the UK. In 2024, the company reported operating profit. Reported operating profit. That's reported. That separate line item 1,000. But this reporting profit includes a restructuring cost 200, which includes staff closure and staff redundancy. And this is what the provision has made. P&L charge 200. Also, the P&L includes foreign exchange gain on debtors, 100. From one of international credit sales. But the policy discontinued. Accept this reality that this restructuring and the forex debtors gain, it's one-off. Management consider the CEO. These events are non-recurring. Therefore, introduce adjusted operating profit. To present by name underlying performance, underlying profit, by name adjusted profit. Do remember, this is what the CEO wish, companies wish. Management intends or wish to present the following disclosure. Same like we covered previously. And the intention is very transparent. They are very honest and very justified point. The information is more relevant for the user of the financial statement. That's the point. But as a finance director of ABC Retail Limited, I wanted to refer IFRS 18 means let's explore this point with viewpoint of IFRS 18. Yes, now the topic is now going to start about the MPM. Okay. So number one, what accounting standard says that what is MPM? What is MPM? MPM is a subtotal of income and expense. Number one, how many components of the financial instrument? Balance sheet, income statement, OCI, cash flow, statement of changes in equity. MPM, it's all about profit and loss account. MPM is all about MPM. If we are going to discuss the MPM, the focus point is P&L. You don't refer the balance sheet. You don't refer the or don't consider cash flow. So whatever we are doing the MPM, focus the point statement of P&L. Exam point. And in fact, the industry point, practical aspect. If someone says that gearing ratio, we are going to discuss as MPM. Gearing, it's never possible as MPM because it's not about income and expense. If someone asks MPM extract from cash flow, it's not possible because the definition first point, MPS is a subtotal of income and expense. Income and expense. So balance sheet items, asset, liability, equity, any combination, it's not MPM. Cash flow, not MPM. It's always about income and expense. Number one. Number two, the important point, the subtotal. Do you know what is the meaning of subtotal? Subtotal means any MPM you wanted to disclose must be some netting off. Means P&L in a broader category, P&L is netting. Netting means income minus expense. MPM also about something netting. For example, adjusted operating profit here. If I say adjusted profit, yeah, this is one adjusted profit. Adjusted profit is a netted off some income, some expense. But for example, if someone asks that my sales, it's based on 5 regions, region A, B, C, D, E, 5 regions, and I wanted to disclose one MPM as 5 region sales is $500,000 minus region A sales, $30,000. So you just adjust the revenue. It's not about net off. It's not MPM. Only one side revenue. If you wanted to disclose one side revenue by making adjustment, it's not subtotal. Subtotal means income minus expense. Same case, one side expense. There are 5 expense and you wanted to disclose MPM as out of 5, 3 expense I wanted to disclose as MPM. It's not possible. So MPM is always about subtotal. Subtotal means something netting about income and expense. It's always about subtotal of income expense. It's not about the balance sheet. It's not about the cash flow. It's not about the ratios. So MPM is a subtotal of income expense defined by management. Defined by management means here CEO is defining, I wanted to disclose this adjusted profit to communicate with the user in a more better way, defined by management. And one last point, this MPN is designed to show performance, performance means P&L in a way that IFRS subtotal do not. IFRS subtotal do not. IFRS subtotal do not means whatever IFRS recommended for subtotal, mandatory or non-mandatory. Mandatory subtotals are operating profit, profit before finance and income tax. IFRS 18 subtotals, mandatory or non-mandatory. These are never ever MPMs because it's already disclosed by IFRS 18. MPMs can be disclosed, MPMs can be disclosed by name MPM, but not the subtotal as mentioned or as suggested, either mandatory or non-mandatory by IFRS 18. So this is about the definition. Let's more clear. Here the case, number one, if we apply this definition here, adjusted profit, adjusted profit, adjusted profit. Number one, adjusted profit. One moment. Adjusted profit, adjusted profit. Here, adjusted profit 1100. It's not IFR, it's not defined subtotal. It's not IFRS defined subtotal. If I rearrange my wording, is this adjusted profit MPM? Point number one. This adjusted profit is not the subtotal defined by IFRS 18. So first criteria is met. Reflects the management view, excluding or adding unusual items. So number one, if the CEO having a wish to disclose this adjusted profit as MPM, the first criteria, this is not the contradiction with the subtotal of IFRS 18, that's met. Okay. Now further, come on, IFRS 18 subtotal operating profit, but here adjusted profit. So that means first criteria is met. It's a subtotal of income expense. Yes, it's a subtotal of income and expense. Number one, it's not about the balance sheet. It's not about the cash flow. And it's not one-sided. One-sided means it's not just the revenue. It's not just the expense. It's a netting off. So therefore, it qualifies for MPM. It qualifies for MPM. Key pointers. Must be income statement. Must be income statement. Yes. Must be extract from income statement. Extract from income statement. Must be subtotal. Must be subtotal. It's not the one side. It means income net of expense. It's not plus minus. It's about income minus expense. Adjust with expense. Not IFRS defined. Not IFRS defined means not the subtotal of IFRS 18, but reflects the management view. Now come on, the exact wordings of IFRS 18. This is what the total definition of IFRS 18. The total definition of IFRS 18. One by one. Listen carefully. IFRS 18 definition. MPM must meet these definitions or these conditions. Means if CEO wanted to or CEO have wished to disclose this disclosure as MPM, all three conditions must have to meet. Don't worry. Majority we have covered above. Now exact wording of IFRS 18. Read it carefully. Read once. What you will write, number one, or what the checklist that this disclosure can be disclosed as MPM. Number one, not listed in IFRS 18 as mandatory subtotal. Not listed in IFRS 18 as mandatory subtotal. It's already covered. Here the case operating profit is IFRS defined, but adjusted operating profit is not. That's why it qualifies as MPM. First. Number two. Third one. First I will cover third one. Communicate management view of performance. This disclosure actually reflects the communication about the performance. Yes. Although P&L also shows the performance, but this disclosure can provide more informative way, but shows the performance. Performance means that's P&L base, not position. Position is about balance sheet, not cash flow. Cash flow is about a statement of cash flow. So in this case, management believes true trading profit is 1100, not 1000. 1100, not 1000. It's not correction of error. It's additional disclosure. It's nothing to make any adjustment through double entries. It's disclosure. So true trading profit 1100 instead of 1000 because restructuring costs and forex gain are unusual, not reflective normal operations. Number one, not the mandatory subtotals, sorry, not listed in IFRS as mandatory subtotals. Okay. In fact, you have to notice one point. Here you have to mention mandatory and non-mandatory as well. Not listed in IFRS 18 as mandatory and any non-mandatory subtotals. Second point, communicates management view of performance. Number three, use that information, this information can be used for public communication. For example, the ABC retail might highlight this operating profit, adjusted profit in annual reports. Annual report is a public communication. Investor presentations. Investor presentation means, for example, there is a financial informations magazine it's going to present. That's called print media, the newspaper, authentic newspaper, business magazines, or you can communicate with the electronic media, formal, one-to-one, or in a presentable way where electronic media having you're a part of the talk show. But it's specifically IFRS 18 investor presentation not includes any social media announcement. All investor presentation is a formalized. Anyways, you can write annual reports. That's all. So that disclosure can be used openly in the communication with the investor formally. Annual accounts is the formal, or another investor presentation model like electronic or print media that's authentic. So that's the definition. If finance director replied to the CEO that, okay, I've checked it, your wish can be fulfilled because it meets the criteria of IFRS 18. But IFRS 18 will tell you how you will present. The disclosure you will make well labeled, well presentable. If you wanted to label adjusted profit, adjusted operating profit, it's better to make present as a label of operating profit before restructuring and excluding one-off forex gain. If you label adjusted profit, that's good. But that label you need to define. That's operating profit. It's actually about before operating costs and excluding one-off forex. Or it's better to label with this name, and avoids misleading the users being specific about what is excluded. This label must be in a manner that's avoid the misleading what you excluded. No? If, for example, if just mentioned adjusted profit, operating profit, that's all, and you haven't explained that, you haven't labeled that what includes this, user here may be misguided. So it's better to label the name operating profit before restructuring and excluding one-off forex gain. Or at least if you label adjusted operating profit, you have to explain very next to disclosure. What does that mean, adjusted operating profit? Now, student, further, I wanted to make discussion here in a manner. If ABC Limited is going to disclose this MPM, the picture of the disclosure is just like this. It's just like this. This will be the disclosure. This highlighted box, it's a complete disclosure. I'm giving you a single minute. Please read it. Pause the video and please read it. Okay, now resume. First of all, imagine that disclosure will be like this. This will be the disclosure portion. This will be the disclosure portion. Disclosure portions of the annual account. The disclosure will present look like this. Number one, this is the first point you have to mention here. And this is what called the reconciliation. Reconciliation means here you will make a heading management defined performance measurement and one line adjusted operating profit. That is operating profit before restructuring and excluding one-off gains. Here user will pick number one, the operating profit referred by here headed IFRS total 1000. So if user want to refer IFRS, okay, operating profit 1000. Then adjust these two transactions and we have find out the adjusted profit 1100. But do remember, this is not only the reconciliation, because you know very well, user of the financial statement, the investor or potential investor, not necessarily the ACCA qualified or CA qualified, maybe doctor, maybe engineer, maybe like me who don't know anything about IFRS 18. You people know very well. So you have to mention the description. Adjusted profit provides user clear picture of the company ABC retailing underlying performance. You have to mention this. By removing unusual forex gain, the one-off data transaction, you have to explain it. That measure avoids overstating profitability. You are explaining the reconciliation as a layman, not any technical point. Adding back restructuring costs, it prevents exceptional expense from masking the strength of the core store operations. You have to gauge this performance by adjusting this restructuring cost. No? That's my performance. You need to project accordingly. In simple terms, this measure help investor and analysts assess the sustainable earning power of the business without distortion of non-recurring events. This is not only enough. IFRS 18 says that also show the calculation method. What method of calculation you have covered here? You have to explain that, because sometimes the reconciliation calculation become complex. You have to explain the method. Adjusted profit is calculated by starting operating profit and then adding back restructuring cost because it is one-off expense, and deducting forex debtors because it's non-recurring, and the operating profit is 1100. So continuation the topic number one, what is the definition of MPM? Number one. Then if meets the definition, what the label should be. Okay. Then you need to present as a reconciliation. Then you have to describe the reconciliation and have to explain the calculation as well. This is the complete picture of IFRS 18 MPM. MPM. Now students, I wanted to cover one important point here. This is not necessarily or compulsory you have to make the reconciliation like this, that you start from IFRS and end with MPM. No, you can make a reverse reconciliation as well. For example, you start highlighting the first row is adjusted profit. The first row is adjusted profit, and then reverse back. Adjusted profit is 1100. What inside? 1100 minus restructuring plus forex debts, and to determine the operating profit. Also, you have all the explanation. I have no worries about that. So first, with the disclosure, user will see the adjusted profit and then reconcile that, okay, this adjusted profit is actually highlighting the regular profit. And if we reconcile the adjusted profit with the one-off items, then we can conclude the operating profit that's similar to the P&L operating profit. So this is not the way, the only one way the reconciliation. Okay, you can make a reconciliation by your own structure, but the principle is that make a reconciliation, have to describe the MPM, have to describe the calculation method. The purpose is transparent. The purpose is to transparent. Last 2 points about the disclosure. Sir, like P&L, balance sheet, cash flows, and most of the disclosure as well, do we need to make comparable statement? Yes, you have to make a comparative statement if possible. For example, with this case, you cannot make a comparative statement with the last year. Because of what? Because last year this one-off items didn't happen. This restructuring cost and the forex issue, it's only happened current year. If these costs have, for any reason, these costs happened or transaction happened previously as well, so you can make a comparative statement. Number 2, do remember that for user, this MPMs is very company specific, entity specific. It's normally not comparable with others entities, but user wanted to know that particular point. What are the sustainable profit, a regular profit other than one-off item? Different industries have. This is a relevant information. But do remember, these MPMs are not compulsions. So it's not necessary that ABC Limited, Retail Limited, if disclose this information, so other industry member will also disclose this. Here IFRS 18 only provide guidance. If any company or any entity wanted to disclose more better performance, the P&L performance, so they can work out, they can disclose by name MPMs. This can be disclosed by MPMs if meet the MPMs criteria. If meet the MPMs criteria. But this point require more discussion. I will let you know a little bit later. Don't worry. But for sure, very simple, comparative statement is possible if available. Okay. Another point. With the disclosure, do we need to disclose with tax effect or with NCI effects? If it's possible. Now listen carefully. This is the disclosure. It's a simple disclosure. It's not about to incorporate. It's not include any tax matter. But if you wanted, and it's preferable to disclose, to make a disclosure with tax effect, the situation will establish in this way. Leave it about operating profit, actually about restructuring and forex gain. So you have what you are mentioning here to the user. Restructuring is 200 and the tax effect means it's a tax allowable expense and the company having a benefit of 50 tax effect benefit. So if it's tax allowable, we will get the advantage of 50 as well. So do we need to add the net column? There is no compulsion. The important thing is that only to mention the tax effect. If you are adding net, it's your discretion. Important is that to show the tax effect. Same, the forex gain on debtors this time 100, but 100 is not the total benefit because it's taxable income. So 25 of the effect of 25 tax will happen accordingly. Further, if this is something about group accounts, so the presentation will be like this. For example, this restructuring belongs to subsidiary, but forex gains is not belongs to subsidiary, it belongs to parent. And your subsidiary holding 80%. Tax rate remains same for parent subsidiary 25%. So you will mention restructuring effect 200, tax effect, tax allowable 50, and NCI effect, it's 40. 200 into 20%, that's 40. Only show the effect, that's all. So this is what about the income tax and NCI point. I hope it's very much clear. Now the next sequence is of the lecture, it's about, yes, what we have covered, this basic discussion, business case. Let's make a reference of the notes. Okay, we have covered the notes, page number 1. It's very clear. It's some facts I have attached here that's mentioned with the study hub. Okay, that's very simple. MPM is about, what is MPM? MPM is a subtotal of income expense used in public communication, communicates management view, not listed in IFRS 18, mandatory or non-mandatory. I have given you, or I have made a lecture till now with one of the possibility of the MPM. Now here need to discuss what are the more possible MPMs. These are the MPMs and MPMs. That's possible. And what are not MPMs? Number 1, if IFRS based profit, operating profit, that's we cannot disclose as MPM. But operating profit adjusts with some items that's meaningful, that can be communicated to the user as a performance of the company's management. Adjusted profit, yes, these are MPM with the explanations. Same if profit before tax, listen carefully, profit before income tax, this one, this is non-mandatory total, but refer by IFRS 18. This profit before tax, it's IFRS recommendation, it's not MPM. But if you adjust any one-off items or 2 or 3 adjustment income expenses, adjusted profit before tax, yes MPM, yes MPM. Net profit, last one, it's not MPM. You cannot disclose as MPM because it's IFRS 18 presentation. But if you adjust some impairment loss, for example, you can disclose as MPM with these descriptions. I'm not reading the description. Revenue, only revenue, but discount or rebates, adjusted revenue. Huh? What you are saying, sir? Revenue? You told that only the revenue cannot be MPM. Here, no. Only the revenue cannot be MPM, but revenue minus cost, the minus discount, minus rebates, that can be one subtotal, means income minus expense, not recommended by IFRS, shows the performance. Sir, can you please elaborate? Listen carefully. ABC Retail Limited, for example, sales, they normally make a sales with 5 different regions, 5 different cities, city 1, 2, 3, 4, 5. If we wanted to disclose revenue as MPM, 5 cities sales is $100,000, but I wanted to show $100,000 minus 1 low sales of 1 region, 2,000, and I wanted to show 4 region sales 98,000. It's not possible because it's only revenue. It's only revenue. One side revenue It's not subtotal. But here what standard says, 5 regions sales 100,000, and we have provided discount for seasonal variations. To support the seasonal variations, we offer the discount. That's a business policy. And discount we have charged with operating expense, let's say, or any treatment of IFRS 15. Leave it. Discount is the expense we bared. That's 12,000. And we wanted to show revenue and adjusted with the discount. This revenue is adjusted with the discount. For example, according to the IFRS 15, 100,000 includes the discount point. Let's suppose 100,000 includes the 15,000 seasonal discount. And here revenue shows 85,000 according to IFRS 15. And you wanted to disclose our sale is 85,000 after adjusting the cost of discount. That's mentioned as the top line item of the IFRS 15. IFRS 85,000. But the disclosure is this: 85,000. Add back the 15,000 discounted sales, discounted loss. So our sales is actually 100,000, but for capture the market or maintain the market for seasonal variation, we offer the discount, and after that the revenue is 85,000. So actually revenue and cost, it's a subtotal. Revenue and cost here discounts. Cost here discount. That's the point. Number 2, EBITDA, earning before interest, tax, depreciation and amortization. Earning before interest, tax, depreciation, amortization, that's a topic you covered with performance measurement or APM, alternate performance measurement. Do remember only EBITDA. Only EBITDA, it's not MPM. Only EBITDA, it's not MPM. Why leave it? Sir, earning before interest, tax, depreciation and amortization, it's not the subtotal of IFRS. But IFRS 18 is strictly mentioned that EBITDA is not MPM. Why leave it for the time being? I will discuss later. Leave it. But do remember, drill in your mind, EBITDA is not management defined performance. IFRS 18 strictly mentioned that we will not facilitate EBITDA as subtotal. We will not facilitate EBITDA as MPM. But if you take the EBITDA and adjust some one-off item, that's called adjusted EBITDA, you can report as MPM. Only EBITDA. Do remember, EBITDA, it's not term used by any accounting standard, including IFRS 18. EBITDA is independent on APM, alternate performance measurement. That's I will discuss later part of the session. That's used by entity by their own structure. It's not about the IFRS. But any of the entity take up the EBITDA and adjust with P&L accounts, they can use, they can refer as MPM. That is MPM. Now I strongly suggest you have to pause this video and read this page. That is about not MPM, page number 41, not MPM. Pause this video and read it. These are not MPMs. Now resume one by one. Subtotal of any income or only expense. That's it, like adjusted revenue. It's never ever possible. That's MPM. Asset, liability, equity, or any combination. Because MPM is always about the extraction from the income statement. Financial ratios, gearing ratio, it's not MPM. Measures of liquidity, current ratios, never. Non-financial performance, customer satisfaction like this, it's not MPM. Common IFRS subtotal, common totals, either mandatory, non-mandatory. Do you know that gross profit is not mandatory? Gross profit is not mandatory, but recommended by IFRS. Same, profit before income tax is not mandatory, but recommended by IFRS team. It's not possible to declare as MPM. Further, subtotals required by IFRS. Operating profit before finance and income tax, profit for the period, operating profits, profit before tax, either mandatory or non-mandatory. Further, I wanted to add here one more thing. OBDI. What is OBDI? Operating profit before depreciation, amortization, impairment. It's also the subtotal company can work out, but not mandatory. So what is this about? Like this. Listen carefully. For example, the company is going to present this P&L, where operating profit is 500,000. The company can also add one subtotal by name OBDI. OBDI means operating profit before depreciation, amortization, I for impairment, not interest, I for impairment. Operating profit before depreciation, amortization, impairment. Like this, operating profit 500,000, add back depreciation, add back amortization, add back impairment, and OBDI. And that can add here after operating profit. It's possible. So OBDI cannot be these. It's also a subtotal, cannot be MPM. That's a point. I have made a list here. For next page you can work out. But do remember, not even a single line. You don't need to memorize anything. You don't need to mug up anything. You just need to read, understand. Rest with my notes, it's mentioned that what the disclosure includes, that description, calculation method, reconciliation, tax, NCI, label, comparability, all I've covered with the ABC example. ABC Limited retailers. That's all I've covered. All these points that I have covered, already covered. But now it's time for a practice question. Now jump to point number 6. We have done the notes reference. Now jump to point number 6. Now come on. Yes, this is a question. A question that's ACCA mentioned with the specimen practice question extract. Kiki, please read this question and refer to my notes as well and develop a key points. Just activity called brainstorming. You have 3 to 4 minutes. Pause the video and start. Don't be over smart. You have to do this. Don't skip that. Don't skip. No, not at all. Don't skip this instruction. Start. Okay, ji, let's start. I hope that you have read and identified the key points. Yes. What the question about? This question, it's not exclusively the MPM, but includes MPM. No? Let's start. Kiki company designs and manufactures children's toys. It prepares financial statement in accordance with IFRS. It has financial year end 31st December X7. Following are the information about the investment property purchase in the financial year. Investment property. Ladies and gentlemen, the question is not about the accounting of the investment property. I know that you people are champions about the IS 40. So there are two models, cost model, fair value model. But this particular question, it's not the viewpoint of accountants or the preparers of the financial statement, but whatever the accounts we will prepare, cost or fair value model, what's the impact with respect to the user of the financial statement? That is about the question. Okay, property as a result of rising property prices. Number one, the complete question scenario, it's about rising property prices. So our question, our answer must reflect in the manner rising, not the decline. A little bit you can incorporate it, but the major portion must have to reflect rising prices. As a result of rising property prices, Kiki purchased 5 buildings during the current period in order to benefit from further capital appreciation. Kiki has never owned investment property before. Oh, never owned. In accordance to IS 40, directors are aware they can measure the building using either the fair value model or cost model. However, they are concerned about the impact. They have concern about the impact. Yes. They are concerned about the impact that the choice will have on the analysis of the Kiki's financial performance. Financial performance with the P&L means P&L, position, balance sheet, cash flow, and the investor, potential investor. And the potential investor. So we have to respond this question. The policy the company will opt either cost or fair value towards the P&L, towards the cash flow, towards the balance sheet, towards the investor as well. That's the question about. Two key indicators of position and performance. Out of four, that's P&L and balance sheet. The two key indicators which Kiki disclose in financial statement as well as public communication outside of financial statement are gearing, debt over equity ratio. So our answer must be focused with viewpoint of gearing and adjusted profit. Adjusted profit. That is profit before finance and income tax. Less or plus adjust fair value gain loss. Adjust profit. Requirement number one is not about MPM. Requirement number two is MPM. Whenever we start discussion about MPM, that is one absolute point that gearing is not MPM. Because it's about debt over equity, it's about balance sheet, as we know that. But the second point, adjusted profit can be MPM or not, we have to justify it. So examiner can examine the question in this way. Okay, now come on. Requirement. Discuss the potential impact that the investment property accounting policy will have on an investor analysis of Kiki's financial statement for the year end 31st December exam. This is not MPM. 8 marks question. Your answer should discuss potential impact on gearing and adjusted profit. 8 marks. So once again, what is about the question? What will be the impact of accounting policy cost or fair value on income statement, balance sheet, cash flow, and the investor with viewpoint of gearing and adjusted profit. So I strongly suggest you have to make 2 headings now, gearing, adjusted profit, and then start brainstorming or start drafting accordingly. What will be the impact of accounting policy of cost or fair value in case of gearing, in case of adjusted profit? Okay. Then next, explain in accordance with IFRS 18 whether gearing and or adjusted profit meet the definition of MPM. It's very simple. Gearing, absolutely not. Adjusted profit, with this case, Maybe, but it depends. First, we refer to the MPM definition, then move on accordingly. This complete question, it's a section B type question. And what I personally think that examiner examine the MPM always with section B type question, because section B type question includes one of the question that's about to report or draft with investor perspective, and MPM is a disclosure aspect and disclosure to provide better information to user of the financial statement to investor. So whenever you draft answer with viewpoint of investor perspective, you will be able to get professional skill marks. But the important point is that your answer, it's not about journal discussion. It's about the requirement base and tilt towards the inclined of your answer must be with investor point of view. Now come on. If we are moving towards the first point, so here I have mentioned some exam point, means brainstorming. Student must have to think and plan the draft in this model. Part A. First, a very easy way, refer the IFRS 18 model. IFRS 40 model. Simple cost model, fair value model. Start with simple. Now always start with simple point and then move on according. Start with simple and focus on requirement. Requirement is impact on gearing. What impact? In case of fair value, in case of cost model. If investment property policy out by company by fair value model. So you have to draft the answer in a way to conclude with investor perspective. Fair value model, and do remember the question mentioned the inclined higher rising prices. With the rising prices, if they opt the fair value model, the value of assets become higher. And asset debit, investment property. P&L credit, P&L categorized to the investment property, investment category. Overall profit increase, equity increases. So resulting the gearing become decrease. Gearing decrease because equity increase, debt over equity formula, denominator become increases, overall ratio become decrease. So denominator become increases, overall gearing decreases. So how this will reflect to the investor? Investor may seek lower financial risk, greater capacity to raise finance. That you need to write in this manner. In case of cost model, depreciation, lower the asset and equity. Depreciation is the expense charged to the investment property and then reflect to the investing category. Profit become decreases, equity become decreases. Denominator decreases, overall gearing will increase. So investor may seek higher risk, weak borrowing position. So that's the clear picture. We are not recommending which model you need to use. We are only highlighting here. However, but the one more point need to consider. Fair value inflates asset base. Okay, gearing become better with the increasing trend of the investment property values. Gearing become decrease. But what about the efficiency ratio? That is asset turnover. Asset turnover. The formula profitability, operating profit divided by value of asset. This reflects utilization of asset. Increasing trend of the investment property where the fair value model applies, higher the asset base, lower, reflecting the weaker or lower the asset efficiency ratio. And this will be the concern point of the investor. This will be the concern point of investor. That's the point. This is what about you need to write for 3 to 4 marks for impact on gearing. But what about impact on profitability? In case the policy of cost Policy of fair value. Fair value model. Fair value model. The fair value gains credit to P&L. Credit to P&L. Okay. But if you consider that point, this model, it's not only reflect for only 1 year. No? Now you need to consider that point. If investor observe the 3 to 4 year situation, okay, fair value gain credit to P&L. But the question is that, is this the gain volatile or stable? The market of the investment property, its movement, it's volatile or stable? It's volatile. It's volatile. It's volatile. Sometime price increases in 10%, sometime 40%, sometime 3%. If investor observe this situation, so what investor will think? Investor may find headline profit unreliable because the situation is bumpy, it's rocky, sometime increase, sometime decrease. So one side of the upward trend of fair value is good, but the trend analysis reflecting or create impression to the investor, it's not something stable. But here, listen carefully, but here the question about adjusted profit. Here, profit before finance and income tax, that's hit to the investment property fair value and reverse the fair value gains. If you disclose this profit, this adjust profit, it strips out gain losses, means adjust the gain or loss and gives more stable indicator of the stable earning. If you provide this information, is adjusted profit, ignore that's what you are communicating to the investor, ignore the fair value gains. So other than fair value gain, the rest of the things are stable. So our headline profit are stable other than this fair value adjustment. That's about the fair value. But what about the cost model? Depreciation decrease the profit, assuming a straight line depreciation. So consistent depreciation, that's predictable. That's predictable. So that means adjusted profit and reported profit both are same. What does that mean? Reported means according to the IFRS. According to the IFRS, the profit that is called profit before income tax. Now all these, that's a subtotal by IFRS. That's include the depreciation. And what about the adjusted profit? You need to mention adjusted profit remain equal the reported IFRS profit, because here adjusted profit you need to disclose that's the adjustment of fair value, but the depreciation is not the fair value adjustment. So that's the point. Your adjusted profit and reported profit both same. So here investor get consistency, and this is more useful forecasting. Overall, adjusted profit improves comparability investors across the model. Examiner ask 4 things need to incorporate. Number 1, number 1, P&L. Number 2, balance sheet. Number 3, investor perspective with viewpoint of these 2 ratios. You have done it. You have done it. But one more thing, the cash flow. Listen carefully. Listen carefully. If a company wanted to opt cost model or fair value model, and if company wanted to decide any one model, cost or fair value, cost model or fair value model. So what's the impact on the cash flows? What's the impact on the cash flows? Either cost model, either fair value model, no difference on the cash flow, because both things not penetrate with the cash flow. In fact, we need to withdraw from the cash flows. In case of cost model, you have to withdraw the depreciation from the profit from investing category according to IFRS 18, because depreciation is a non-cash item. And in case of fair value model, you need to adjust or withdraw the fair value adjustment solved for non-cash item from the investment category profit. Yes or no? No impacts. And final wording, if we are going to make the cash flows, and that's called investing category. So it's very simple. Investing category not includes the depreciation. So ignore the depreciation of the property planning, depreciation of the investment property. And not includes a fair value adjustment. So ignore the fair value adjustment. You don't need to make any adjustment. So in simple words, with cash flows, it's with viewpoint of the cash flows, it doesn't matter either use cost model or fair value model. That's all. Now next point. Next point is about students. Next point is about this one. MPM. Explain in accordance with IFRS 18 whether gearing or adjusted profit. Gearing is debt over equity. Adjusted profit, profit before finance income tax. Profit before finance income tax is a subtotal recommended by the IFRS 18. But here need to adjust the fair value. So we need to make discussion for MPM. First, very blunt. We have to refer the IFRS 18. And number two, just sideline the gearing. That gearing is not MPM. And let's make a discussion about the adjusted profit. If that meets that criteria, okay, go ahead. So 3 to 4 marks, and even examiner asks you for 5 marks, you have to start this. Definition of NPM. MPM is a subtotal of income expense. It's a subtotal, yes. Use externally, not required by IFRS. Number one, gearing, not MPM. Adjusted profit is a subtotal. Strip adjusting the fair value gain loss. Use externally, that directly help investor to see the underlying performance. And you have to add more points accordingly, whatever we have discussed before. Sir, if we are a student, ACCA published the model answer. As a student, how much we should write accordingly. This is for you, the smart answers. For 8 marks, you have to write this, whatever we have discussed above. This is what the examiner expects from you. And for particular for MPM, that's the MPM. This is the point, the MPM. First definition, then application. Here I have also highlighted what the professional skill marks related to investor focus. Whatever I have suggested you above, I have mentioned here. I hope that it's very much clear till now what is MPM and how the examiner can examine. Now it's time to make a final discussion, and it's something for, yes, EBITDA and OBDI. EBITDA and OBDI. Let's take a break. Let's take a break for 2 to 3 minutes. Now welcome back. The last component of this topic. Students, listen carefully. I need a, please concentrate here. Focus here. Listen this point very carefully. Leave it about the income statement or like this. No? There is a broader discussion I wanted to cover here. No? Number one, do you agree that, for example, this is a Toyota company. This is a Toyota company financial statement. the statement of financial position, statement of P&L, including the cash flow as well, what that information shows to the investor. This is all about the performance of the company, that's P&L. That's position of the company, that's balance sheet. Exactly this one. No? User observe the annual accounts as the company performance and the positions. And user use this information for the decision making. So if I say to you that as a company management, what we do, we provide information. What I'm giving the word, the information as suggested by all IFRS. It's IFRS 18 is the presentation, no? But presentation includes multiple more things. For example, property plant equipment, for example, IS16, for example, IFRS 15, revenue, IS19, blah, 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 blah. Information, number one, we present the information of all the financial statement according to the IFRS. Yes, number one. Now, next point. Once again, we as the management of the company, and the management is responsible for providing the best and transparent information to the user of the financial statement. So as management, if we have opted IFRS, number one IFRS, to make the financial statement considering the best way to translate or best way to provide the information to the user, number one. But and this financial statement includes the statement of financial position plus income statement plus cash flow statement, changes, equity, OCI, all these, and the IFRS recommended notes. For example, IS19 notes, whatever suggested by IS19. So this is what about the picture, no? All these. But once again, as management, it's not compulsory, or there is no compulsion on management. That's if they provide information to the user, that's they will only use the information that's suggested by IFRS. Other more information about the company's position, balance sheet, about company's position, about company performance, income statement, and more description that notes, the company can also publish. That is not recommended by IFRS. And that's one of the examples you studied, APM. Alternate or advanced performance measurement. Alternate performance measurement. And this includes, for example, EBITDA. For example, gearing ratio. EBITDA is P&L extracted, gearing ratios, and more. For example, more free cash flows and more. For example, something like underlying profit and like this. Do remember that the topic APM that you have already covered, it's not under the scope of IFRS. But the new development of IFRS, that is IFRS 18 particular topic of MPM. So number one, MPM, it's not the part of P&L, income statement, balance sheet, cash flow presentation. It's about the disclosure. Disclosure extracted from P&L, the subtotal and all these things. So IFRS accounting standard first time through IFRS 18, through IFRS 18 guided to the entity if they wanted to provide information as a disclosure other than point number one. So use that MPMs, use that guidance and declared as MPMs. So you can classify like this. According to IFRS, there are two guidelines. These are IFRS. Once again, if the management wanted to present information to the user of the financial statement about all the financial matters, they will use IFRS for financial statement preparation, including all components plus notes. And also for disclosure, use the MPM. But if disclosure wanted to make through MPM, use the guideline referred by the IFRS 18. But the question is that is the other information that we covered, APM is still relevant? So answer is that management is not bound to suppose, there is no compulsion that only the information of finance is provided through IFRS. Management can also provide other information to the user of the financial statement that's not under the scope of IFRS. So here the answer is yes. So answer is this: APM is still relevant. Yes, still relevant. Like EBITDA, like gearing, free cash flows. But do remember, APM is still relevant, but APM is not under the scope of any IFRS. So any of the entity wanted to disclose gearing ratio, is that allowed? Allowed. In fact, the word allowed is not relevant here, because I must say, is that under the scope of IFRS 18 or any IFRS? No. But this gearing not under the scope of MPM? Yes. Can the entity disclose the information EBITDA? Not the MPM. Categorically mentioned EBITDA is not MPM. Yes, they can disclose by the name EBITDA and its APM. So any of these information, if the company wanted to disclose, they can do that, but they are not bound to follow the instructions mentioned with MPM. That is what we wanted to cover. Clarification, need clarification. APM versus MPM in SBR. Are additional performance measure still examinable? Yes, it's relevant, examinable. Very broader picture. And very clear here. What is the difference between APM and MPM? MPM defined by IFRS 18. Very focused. The subtotal, number one, subtotal and income and expense. And IFRS 18 recommended specific disclosure requirement, example, reconciliation, explanation, and all the tax and NCFX. But APM, this is what a broader category, not limited to IFRS 18. Can include figures outside the income statement like free cash flow, net debts, ROC. It's not necessarily that's about the income statement. Not mandatory IFRS 18 disclosure, but still relevant, provide a faithful representation. If any of the company use the IFRS 18 MPM model for APMs, they are allowed. That's good, because IFRS 18 have given you the proper guidance. And a very deep statement, all MPMs are advanced performance measurement. But not all APMs are management defined performance measurement of IFRS 18. Whatever we studied the MPM, all MPMs, adjusted profit like this, are APMs, but not all APMs like gearing, like free cash flows. These are not MPMs. For if you wanted to qualify MPM, you have to meet the definition of MPM. Need to clarify these points. Very important. That is the focus point. Last 5 to 10 minutes. Number one, what is EBITDA? And is this APM or MPM? And what is OBDI? The very first is EBITDA, earning before interest, tax, depreciation, amortization. Very categorically, EBITDA is APM and you can disclose, but not MPM, not disclose according to IFRS 18. If examiner ask you why it's not, just mention this. It's not IFRS specified subtotal, and different companies use it. The problem of EBITDA is that the different company you can calculate EBITDA in different manners. There is no standardization of EBITDA. That's why IFRS 18 ignored the EBITDA. You can consider that as exception. Ignore it. It's never possible to use MPM. But if you adjust EBITDA adjusts with some restructuring cost, then you can use MPM. Here the simple illustration. EBITDA, operating profit 1000, depreciation 200, add back, depreciation, amortization, add back. It's APM, not MPM. But adjusted EBITDA, for example, 1250, adjust restructuring costs and adjusted EBITDA 1350, you can use as MPM. You can use as MPM. Number two, another point, OBDI. As I've already told you, OBDI, students, OBDI. OBDI is a term used by accounting standard. Here is the term. OBDI. Operating profit before depreciation, amortization, and impairment. It's IFRS 18 refer the term OBDI and also says that the company use as non-mandatory subtotal. That's operating profit before depreciation, amortization, and impairment. They can use that. Operating profit before depreciation, amortization, impairment. Introduced by IFRS 18 like EBITDA, but it's not EBITDA. Before moving towards the question and the things, I strongly suggest you have to read this content just to emphasize the point. Read it, please. Yes. Mandatory versus non-mandatory. IFRS 18, mandatory or optional subtotals. Mandatory subtotals. Operating profit, profit or loss before finance, income tax, profit or loss after tax. That's a bottom line. These three are compulsory. User can use for comparability, and this is for consistency as well. Optional. Profit before income tax, optional. If IFRS 5 applied, then the profit loss from continued and discontinued, that's compulsory. At that time compulsory. Normally it's not compulsory. That's why I must not say that it's mandatory. And OBDI. IFRS 18 specifically permitted as EBITDA. But the entity or management can define subtotals if they follow IFRS 18 rules for additional subtotals. Management can also add or can create own subtotals, but the condition should be this. Condition is this: must be derived from recognized income and expense, consistently applied, clearly labeled, and that should not much prominent as compared to mandatory. Very exceptional if examiner asks this. There is a question: is it possible that company can create own subtotal like optional? The company use subtotal owns. Yes, but if the company meets these conditions, must be derived from recognized expense, income expense, and this this should be applied consistently. Means it's not possible that year 1 for year 2024 you use that subtotal, then 2025 you will not use, then use 26, 27, then not use in the 28. No, you have to apply consistently. The label is very clear and the prominence is not more than the mandatory requirements. That's the point. Now come to the point. What we were discussing, OBDI. OBDI is a recommended, it's not entity created. It's also mentioned by IFRS 18 as optional. It's not mandatory. It's an optional permitted subtotal allowed on the phase of P&L if meets IFRS 18 rules for additional subtotals. This is very important. OBDI is not MPM. Why not MPM? Because it's already suggested by IFRS 18. It doesn't matter. It doesn't matter. It's optional. But it's advised by IFRS 18 as optional subtotal. Because it's already recognized by IFRS 18, IFRS specified subtotal. Optional specified subtotal. Now it's a simple illustration. It's a very simple illustration. If there is some requirement about OBDI, then how to calculate OBDI? Take out the operating profit, that's mandatory subtotal, and then make a calculation by reversing depreciation. All depreciation that's affect to the operating profit. All amortization affect to the operating profit. All impairment affect to the operating profit. Then calculate OBDI. It's not MPM. Yes, adjusted OBDI. For example, OBDI adjusts with reverse back, add back the restructuring cost. That can be MPM. Ladies and gentlemen, this is all about the IFRS 18. All content of the IFRS 18 is done. I strongly suggest, particular for MPM, you have to attempt this question to BASCO. Self-attempt. Take out that question from Kaplan Kit. In fact, I will attach that question with that practice question as well. Thank you very much. Take care a lot. Bye-bye. If you have any query, you can ask me on the WhatsApp. Take care. Bye-bye. Signing off. Assalamu alaikum.